Hello there, this is Brian. Thanks so much for listening to this video series on futures trading. Trading futures may sound intimidating, like designing the flux capacitor in Back to the Future, but it's quite easy and often is simpler than trading stocks, options, and Forex. Trading futures can be done with a much smaller amount of money than is required for stocks or options. The minimum amount of money you need to get started in futures is only $5,000. Day trading stocks and options has a higher starting cost of $25,000 to $30,000 because of the FINRA requirement known as the Pattern Day Trader Rule. Day trading futures is often easier than swing trading stocks and options because you don't need to worry about unexpected news wiping you out overnight. Day trading stocks has a much lower profit than the same trade done as a futures trade. Trading futures is often more profitable than trading Forex. Forex brokers make their profit by skimming the spread, which costs you far more than stock, options, or futures commissions. So what are futures contracts? If you buy a futures contract, you're agreeing to buy something from a seller for future delivery at a specific price, which can be based on or derived from something else, like stocks, bonds, commodities, indexes, and more. The goal of day trading futures is to make money from buying and selling the price movement. You don't have to deliver or receive the actual underlying asset, just trade the electronic contract. One important rule of day trading futures is never hold a contract overnight. Some people do this to try and save a losing position, while others do it to try to make a lot more money in the overnight session, if it goes in their favor. But the risk level of holding contracts overnight is too high. Here are some benefits to trading futures. Trading futures offers huge leverage. Less capital is required for you to get started, and there's no restriction on how many trades you can take. The futures market trades 24 hours a day during the business week, allowing you more opportunity to capture moves while you're at home. Day trading futures allows you to make money on both sides of the trade by going long and selling short with equal ease. Trading futures contracts allows you to trade a wider variety of related and unrelated markets. One of the best features of trading futures markets is how much leverage you get. Let's see how it works. Futures trade in units called ticks. A tick is the smallest amount that a price can fluctuate. Typically, there are 4 ticks within 1 point. In this example, you can see that 1 point would be from 2350 to 2351. Each tick within a point equals a quarter. Therefore, 1 tick would be from 2350 to 2350.25. In futures contracts, a full whole number change is often called a handle rather than a point. If you make 2 points on a trade, then you would say that you made 2 handles on the trade. Futures contracts are sometimes traded in full-size contracts and mini-size contracts. Mini-size contracts are typically only traded electronically, and thus are often called E-mini for electronic mini-size. Full-size contracts are usually traded in a trading pit by people. The S&P 500 full-size contract is labeled SP, while the mini-size contract is ES. ES trades at 1/5 the leverage of SP. Some futures contracts have the same leverage for both the pit-traded contract and the electronic contract, such as the very popular 10-year U.S. Treasury bond futures contracts. You should only trade the pit contract if you need to make large-size trades. The electronic contract will give you a faster fill at a better price in most cases. Take a closer look at these examples. If we were trading one S&P 500 E-mini contract, symbol ES, 1 tick equals $12.50. Assume you're trading in a market where one handle has 4 ticks within it. So $12.50 times 4 equals $50. Just for argument's sake, we'll say that the current level of the S&P 500 E-mini contract is trading at $1,300. $50 multiplied by the current price of $1,300 equals $65,000 of leverage. If the current requirement to buy or sell one contract is $5,000, then your money is leveraged up to $65,000 per contract. Because trades can make or lose a lot of money quickly in the hands of the trader, it's best to paper trade first and hone your skills before trading real money. The cost of putting on a trade is the performance bond. This is the amount of money you must set aside for each contract that you trade. The performance bond cost varies from market to market and from month to month based on recent volatility. A performance bond is also called margin by traders, which is different than a stock margin account because you don't pay interest and you're not borrowing money. It's more like a security deposit. There are two types of minimum costs for performance bonds: an initial performance bond requirement and a maintenance requirement. The initial performance bond requirement is the minimum amount of money you need to start trading. The maintenance bond minimum is the least amount of equity necessary to keep the trade open. If you fall below the maintenance requirement, then your broker will liquidate your position. For example, if the initial margin requirement is $4,000 and the maintenance requirement is $3,000, and if your account lost more than $1,000 during the trade, then you must close the trade, or your broker will do it for you. These are some of the most actively traded futures. The S&P 500 E-mini contract, symbol ES. The mini Dow Jones Index, symbol YM. The NASDAQ 100 E-mini contract, symbol NQ. The 10-year U.S. Treasury note, symbols TY and ZN. Euro versus dollar futures, symbol EC. Gold futures, symbol GC. And light sweet crude oil, symbol CL. If you're not familiar with agriculture cycles, then you should probably avoid agricultural futures contracts. Be sure to view part 2 of this video series on futures trading. This has been a Capital Management Institute production. Come learn with us at capitalmanagementinstitute.com. Thank you for watching.